Every market cycle produces two types of investors: those who attempt to predict outcomes, and those who commit to a repeatable process. Prediction is attractive, it promises control, it implies that with sufficient intelligence, information, or speed, one can consistently deploy capital at optimal moments. History suggests otherwise, and in each period, investors were forced to confront the same question: stay invested or step aside. Despite repeated disruptions, diversified equity markets have demonstrated long-term structural growth. This does not mean the path was smooth. It was not. Drawdowns of 20, 30, even 50% occurred across cycles. Recovery periods varied. Confidence fluctuated. Yet the long-term trajectory remained upward. For individual investors, the central challenge is rarely identifying opportunity. It is remaining invested through uncertainty, without allowing emotion to dictate allocation decisions. This is where structure becomes more important than prediction. Dollar cost averaging, the systematic investment of fixed capital at regular intervals, represents one framework designed to align capital deployment with the reality of volatility. Today we examine this framework not through slogans, but through evidence, behavioral dynamics, historical stress periods, statistical context, and implementation discipline. The primary risk facing most investors is not market volatility itself, it is behavioral response to volatility. Multiple studies analyzing investor flows during market downturns demonstrate a consistent pattern. Individuals tend to reduce exposure during drawdowns and increase exposure after recoveries. This behavioral asymmetry leads to systematically buying high and selling low, the opposite of what long-term wealth accumulation requires. This behavior is not irrational in isolation. It is human. Loss aversion, recency bias, and social reinforcement amplify fear during downturns and optimism during rallies. Information flow accelerates emotional reaction. Market headlines intensify uncertainty. The result is discretionary allocation shifts that erode long-term returns. Dollar cost averaging introduces a mechanical constraint into this environment: a fixed amount of capital, allocated at fixed intervals, independent of short-term price movement. When markets decline, the same amount of capital acquires more units. When markets rise, it acquires fewer units. Over time, this generates an average acquisition cost shaped by dispersion rather than emotional timing. It is important to clarify, dollar cost averaging does not eliminate volatility. It does not guarantee superior returns in all conditions. It does not predict direction. It systematizes participation. In doing so, it reduces the probability that behavioral impulses override strategic allocation. To evaluate structural resilience, we examine one of the most severe market disruptions in modern history, the 2008 global financial crisis. Dominated financial discourse. Headlines question systemic stability. Under a lump sum allocation, investor A experiences the full magnitude of the drawdown immediately. Portfolio value declines sharply. Recovery under a lump sum allocation, investor A experiences the full magnitude of the drawdown immediately. Portfolio value declines sharply. Recovery to break even requires nearly 5 years, extending into 2012-2013. Investor B, following a systematic monthly allocation, continues deploying capital throughout 2008 and 2009. As prices decline, each fixed contribution acquires more units. The average acquisition cost declines materially relative to the initial peak price. By the time markets recover in 2013, Investor B's cumulative portfolio value exceeds that of Investor A. The difference is not predictive skill. It is exposure continuity combined with cost averaging during periods of stress. The lesson is not that timing is irrelevant, it is that timing is unreliable, particularly under emotional pressure. Systematic allocation does not remove pain during drawdowns. It reframes volatility as a structured input rather than an uncontrollable threat. While equity markets provide long historical datasets, high volatility assets offer a compressed illustration of similar dynamics. In late 2021, Bitcoin reached approximately $69,000. Over the subsequent 12 months, the asset declined more than 70%. Sentiment shifted rapidly from enthusiasm to skepticism. Consider again two allocation approaches. An investor allocating full capital at the peak experiences a substantial drawdown. Recovery to prior levels requires significant appreciation from depressed prices. Alternatively, a systematic weekly allocation throughout 2022 lowers the average acquisition cost substantially. As prices decline, fixed contributions acquire progressively more units. The cost basis adjusts downward through volatility. When market conditions improve and price appreciation resumes, recovery occurs from a lower average cost level. this does not imply that all volatile assets justify systematic averaging. Asset quality, structural viability, and long-term relevance remain critical considerations. However, in environments characterized by extreme dispersion, systematic allocation can transform volatility into a mechanism of accumulation rather than deterrence. Volatility, when approached structurally, becomes an input. A rigorous evaluation requires acknowledging trade-offs. Historically, in steadily rising markets, lump sum investing outperforms dollar-cost averaging approximately 2/3 of the time. This reflects the upward drift inherent in long-term capital markets. Deploying capital immediately maximizes time exposure to that drift. From a purely mathematical standpoint, earlier exposure often dominates gradual exposure. However, this advantage assumes psychological stability, the ability to tolerate immediate drawdowns without reducing allocation. It assumes that investors can withstand substantial short-term losses while maintaining conviction. Empirical evidence suggests that many investors struggle with this requirement. Thus, the choice between lump sum and systematic allocation is not solely statistical, it is behavioral. For investors with strong risk tolerance and long-term discipline, lump sum allocation may optimize expected return. For investors vulnerable to emotional reaction during drawdowns, dollar-cost averaging may improve realized outcomes by enforcing consistency. Optimization on paper is not always optimization in practice. Dollar-cost averaging is not universally appropriate. Its effectiveness depends on context. First, asset selection matters. Systematic allocation should be applied to diversified, structurally resilient assets, such as broad equity indices or networks with durable economic relevance. Averaging into deteriorating fundamentals compounds risk rather than mitigates it. Second, time horizon must be long enough to accommodate market cycles. Systematic allocation over months is insufficient. The framework assumes multi-year exposure. Third, automation is critical. Manual discretion reintroduces behavioral interference. Automated deployment reduces the likelihood of emotional deviation. Fourth, allocation size must be sustainable. Contributions should not compromise liquidity or induce forced selling during downturns. When these conditions are satisfied, dollar-cost averaging functions as a volatility absorption mechanism. It does not eliminate risk. It does not guarantee outperformance. It reduces the probability of behavioral misalignment. Capital markets are inherently volatile. Cycles expand and contract. Narratives shift. Sentiment oscillates. In this environment, the pursuit of precision often conflicts with the requirement for endurance. Dollar-cost averaging represents a structural response to this tension. It replaces discretionary timing with disciplined participation. It reframes volatility from a signal to react into a condition to incorporate. Over extended time horizons, capital markets have rewarded persistence more consistently than prediction. The question is not whether volatility will occur, it is whether your process can withstand it. Structure over speculation.